Okay, it's 2 o'clock. We've got about 175 people on. The rest will should be coming on shortly. So let's get started. Um, Want to thank again our conference committee, Mike Martin, chair, and putting together a lot of good sessions. This next session on the economy, what will the future bring? Obviously, very, very relevant to what we're trying to get through as finance officers. Our presenter from Bank of America, Aditya, probably butchering that, but he said that's okay earlier. So yeah, I thank you for volunteering to present to us, and looking forward to hearing your presentation. All yours.
Okay, thank you. Good afternoon, everyone. Thank you for taking the time. By way of introduction, I work in the global economics team at Bank of America Global Research. What does that mean? We spend about, I'd say, half of our time looking at the US, since we work closely with the US team. You know, we sit with them when we're all in the office. And then the other half, thinking about the rest of the world. That includes the other developed economies. It includes EM. And it includes kind of thematic stuff where, we look across regions or economies and so on. So I'll talk about, a little bit about the world and a little bit about the US in this presentation. So let's, with that said, let's get started and go to slide 2. This is kind of a brief overview of where we stand. Obviously, this is the deepest downturn since the Great Depression. And what's important here is that it is really a unique shock, in the sense that it is a self-imposed supply shutdown rather than a more typical demand slowdown, which means that it's a lot quicker on the way down, and it's probably going to be a lot quicker on the way up as well. In terms of the virus itself, global cases have been kind of petering around at 250,000, not really going up, not coming down. US cases, however, have fallen off from the peak of June and July. So we had that surge in June and July. We got up to, I believe, about 60, almost 70,000 cases per day. Now we're closer to 40,000, but we seem to be plateauing off, and that's a bit of a concern. I'll talk more about that a little later. Looking ahead, we do expect more hotspots. Some of the forecasts for the flu season are very dire, very concerning. But even if those don't play out, we do want to make the point that the virus itself hasn't changed, right? Our behavior has changed, and that has helped slow down the virus, but the nature of the virus is still the same. And so as people and regions get a little bit more, lax, certainly there will be more hotspots going forward. And all of that put together means, more targeted measures, more voluntary social distancing, people not as enthusiastic about taking vacations or eating indoors in restaurants. And that means an incomplete recovery next year. So that's all of the bad news. In terms of the good news, the policy response has been tremendous. First monetary, then fiscal, off the charts easing, both in the US and abroad. And in our view, that doesn't necessarily create inflation, but it does fill some of the holes. So it reduces the downsides to the economy and inflation. Okay, and then finally, in terms of risks, the key upside risk is the vaccine. Our base case is we get a vaccine in the third quarter. A potential upside, a very optimistic upside, is that we get it in the first quarter of next year. We'll talk about the implications of that. And then in terms of downside risks, US-China relations have gotten worse as a result of the pandemic. They were pretty bad to begin with. And then there's also policy fatigue, so we might not get another stimulus bill. That's becoming less likely, a bill is, as we get closer to the election. And of course, the election itself is a potential source of risk. So let's move on to the next slide now. here are our growth forecasts. I just want to highlight a couple of updates. The US is now negative 4.3%, not 5.3%, because we've become more optimistic about the third quarter. And then next year is positive 3.8% rather than 2.9%. So that pushes the global numbers up about a tenth as well. But the broader message is still the same. This year, the numbers are really terrible across the world, unprecedented. And then next year's numbers look very strong. So if you just look at growth rates, it looks like a very V-shaped recovery, but I think you should focus on the column on the right of the table on chart 3, which shows that the cumulative downward revisions relative to pre-virus, so old means before the pandemic, the cumulative downward revisions to our forecasts are still very large. So this is a very negative shock. To kind of reiterate the point on V-shaped growth rates, you can look at the chart on the right. These are the 3 big economies, and 2008-09 is actually on this chart. However, it looks like a blip.
I can hear you.
You can hear me? Okay, people can hear me. All right. Sorry about that. Okay, so the column on the right of the table here shows how large our downward revisions have been relative to before the start of the pandemic. And then to highlight the very V-shaped growth rates that we're seeing, the quick dip and then recovery, you can look at the chart on the right. And what you see here is, negative 35% basically to negative 40% in every economy in the quarter that they were shut down. So in China, that was the first quarter. In the US and Europe, that was really the second quarter. And then huge bounce backs the following quarter. So for China, we already got the number. It was close to 60%. This is Q over Q annualized. And then for the US and Europe, we're expecting some big numbers as well. Now, the important point to make here is that we shouldn't be fooled by these very V-shaped growth rates, because we should be looking at the level of activity, not the growth rate. So the way I like to think about this is, think of an athlete that's torn her or his ACL. Right? So for a few weeks, they're going to be doing absolutely nothing. They're going to be sitting on the couch. Then when they're better, they're going to get back to, doing what they do best. And they'll basically go from 0 to say 90% immediately. So if you just look at the growth rate, it'll look very impressive, right? But the problem is that they're still 10% worse than they were before the injury. And then the question for the longer term is, can they find new ways to do things that get them back to where they were, or do they fully recover as the economy would in the event of a very quick vaccine? So that's, I think, the main point here, that we are still well below historical levels of activity. Let's go to the next chart. Okay, so in terms of the virus, there's obviously a lot of bad news out there. A few kind of less depressing facts. First of all, new cases around the world, as I said, we've kind of flatlined at 250,000. India, the US, and Brazil account for about 60% of global cases and 25% of the world's population. So as long as those 3 countries aggregate doesn't really increase, we should be okay globally. The US and Brazil have peaked. India is showing some signs of peaking, and then of course we have new hotspots in particularly in Europe, where things are getting bad quite fast. Now, obviously, this is happening in an environment of increased testing, which means that true cases might have already peaked because we're getting the same number of cases for more tests. Importantly, we haven't needed, at least in the US, we haven't needed draconian lockdowns to bend the curve. So you see what it took to bend the curve in March, April versus what it took to bend the curve in June, July. And it basically took kind of a lot more commonsensical stuff in June, July. We didn't need to shut down the economy. And I think that's a function of the fact that we understand the virus a little bit better now. Deaths have also peaked. That's kind of interesting. Deaths globally peaked around the same time as cases. It was strange. Part of the story there is that the virus has moved to EM, where younger people are getting sick, so the outcomes are not as bad. And the other part of the story is improved treatments. And I think this is important because a lot of negative stuff has been said, rightly or not, about the lockdowns and the economic damage that they caused. But the one big positive, I think, was that they bought us time. They bought the rest of the world time to understand how to treat the virus. And so other parts of the US, other parts of the world learned from the very unfortunate experiences of Italy and New York. And they're a lot better at preventing deaths now than they were in March and April. And then the last thing is that there's some anecdotal evidence from some very underprivileged parts of Mumbai, which is the most populous city in India, that actually a very large number of people were exposed to the virus. So in some of the poorest parts of the city, they had seroprevalence rates of almost 60%. That's 60% tested positive for antibodies, even though there were very few actually detected cases there and very few deaths. So it shows that perhaps some of the underprivileged parts of the world might be able to deal with this virus a little bit better than we thought. Moving on to the next chart. Now let's talk about China, Europe, and the US in that order, because that's the order in which the virus is kind of spread. And there's some lessons, particularly from China, in terms of how we can think about the recovery. So obviously, China has had the most robust recovery. You can see that in the congestion index on the left. And you can see that in subway ridership on the right as well. However, I think what's really interesting about the chart on the right is the blue line, which shows Beijing. Now, in early June, Beijing actually had a mini outbreak. They shut down some parts of the city, but most of it actually remained open because it was kind of in the outskirts of the city. Yet, subway ridership plummeted. This was voluntary behavior. And that's important because it shows us that the economic costs of the virus are not just because of lockdowns, they are because of voluntary social distancing. So this really shows the power of that. Moving on to the next page. You can see the economic recovery here. Industrial production has recovered, very robustly. Auto sales have gotten stronger as well. There's actually some interesting things about the story around autos. First of all, goods demand has benefited just from the fact that people who didn't lose their jobs actually have some money lying around because they didn't take vacations, they're not eating out. So they might end up buying more goods. So there's the substitution happening from services to goods. And then autos are more useful in the pandemic as well because some people just don't want to ride the subway. So that's another reason. And then the third, of course, is pent-up demand. So there were some people that were going to buy cars in Jan and Feb, and they couldn't because everything was shut down, so they bought them later. Okay, so pretty strong recovery in China. Moving on to Europe. On the next page, yep. So these data are a little bit old. Since then, things have gotten even worse in Europe. So you can see that, as the lockdowns eased, a lot of people got a little bit lax. They managed to come down to, 2,000 cases a day in the big 5 European countries, which have a similar population to the US. And that, I think, made people a little complacent. They took their summer vacations, and you can see that the outbreaks have been worst in places where people took summer vacations, Spain and France. And now, of course, things are getting a little worse in the UK as well. So far, death numbers have not been terrible in Europe. Deaths lag, of course. But it's also a function of the fact that younger people got sick, older people are being more careful. So you can see that in the chart on the right where deaths have not been happening at the same pace as they were in the first wave. Moving on to the next page. In terms of the economic recovery itself, you can see that Europe is still struggling. Basically, every sector in the chart on the left, you don't need to read all the labels. The point here is that every sector is at significantly lower capacity utilization than it was in the first quarter. And the first quarter, the lockdowns had actually started. So, if you compare it to last year, these numbers would be even more drastic. The blue lines are for Q2 versus Q1, and then the yellow lines are Q3 versus Q1. So in Q3, we haven't even gotten back to Q1 levels. Moving to the chart on the right, you can see that numbers of unemployed people, as well as unemployment rates, are significantly higher than they were before COVID. I don't know exactly what's going on with France. I'll have to check that out. It's a slightly strange data point. Moving on to the next page now, the US. So cases are falling, but as I said, not fast enough. Since we published this chart, they've sort of dipped a bit and then picked back up to the levels that you can see on this chart. The story here is that the hotspots are just kind of bouncing around. So first it was the Northeast, then it was the South and the West. Now, more recently, it's been the Midwest, Iowa, North Dakota, South Dakota. The worry here is that the number of cases that we have going into the fall is what is going to set the baseline for what many people expect will be the next outbreak. And many epidemiologists think, and I'm not an expert on this, so I go by what they say, they think that an outbreak in the flu season is almost inevitable. So if we can go back down to the numbers that Europe was at, 2,000 cases a day, that would be very helpful. But if we're stuck at 40,000 cases a day, admittedly, the US tests a little more than Europe, but if we're stuck at 40,000 cases a day, then that's a lot more worrying because the numbers could increase and get out of hand very quickly. The other thing you'll notice in this chart is that the June-July wave looks a lot larger than the March-April wave. We think that's just a function of testing. If you look at the deaths numbers, most likely March-April was a much larger wave. There were a lot more cases out there. For example, I read an estimate somewhere that there were 10,000 cases in New York City even before they had diagnosed the first one. So clearly we were just not testing at that point. Moving to the chart on the right, this is less true in the latest data, but I still want to highlight it because it's something we're concerned about. We are testing a lot in the US, but it's a little concerning that we might be testing in the wrong places. So the regions that are testing a lot are the Mid-Atlantic, where we are right now, and New England, and to a certain degree, the West Coast. But that's not where a lot of the cases are. And some regions with relatively high case counts are just not testing a lot. So in aggregate, the US is testing a lot, and that's a positive. But if you get into the details, it's a little bit concerning. But again, as I said, the negative correlation that you can see on this chart on the right is less strong now. So that's good. Moving on to the next page, page 10. Here are some reasons. I mean, I give you a lot of bad news, so I try to throw in a slide every now and then to convince you that maybe things won't be that bad, right? So here are some reasons why maybe the next wave won't be as painful. We call it the benefits of diversity. So in the first round, the virus spread a lot through super spreader activities. Sports events, music concerts. There's a story of a soccer game in Italy that they referred to as a biological bomb. Then obviously we also didn't know, we didn't have any clue at the start of this year how to protect vulnerable people from the virus. Things are a lot better now on all of those counts. There are some people that we call super spreader individuals who have a lot more social contacts, whether it's professional or personal, than other people. They're probably the ones that did a lot of the spreading, but they probably got the virus themselves, right? That's why they were spreading it. Those people are probably immune now. And they're just not doing those activities because the super spreader activities are largely shut down, right? We're doing this conference, for example, by Zoom. So that helps control the spread. And then, of course, we have a much better idea as to how to protect vulnerable people. So, hopefully this surge certainly has been smaller than March, April, the June, July surge, and hopefully the next one will be smaller as well. Moving on. What's happening in the economy? Mobility recovered to a certain degree, and then it kind of stalled out. So what's the story here? This is a kind of a mobility index maintained by the Dallas Fed. You can see it falls off a cliff basically when the outbreak starts, and then it starts to recover. It recovers quicker in the regions that opened up first, but then they had their outbreaks, and then the Northeast kind of caught up with them, right? And then at some point we flatlined. And I think the story there again is the power of voluntary social distancing. So yes, removing restrictions will help mobility and it'll help the economy to a certain degree, but beyond a point, people are cutting down mobility by choice, not because they're forced to. They don't want to eat at restaurants as much. They don't want to do various other activities that might actually be available to them. One of those is flying. So, take a look at the chart on the right. This is a sector that's obviously structurally impaired. Passenger throughput in US airports is typically 2 to 2.5 million per day. We're now puttering around 700,000 maybe. That looks like where we are. So there's a few other sectors like this that are just not going to recover until we get a vaccine. Moving on to the next chart. So this is our proprietary aggregate card data. The word aggregate is important because the disclaimer here is that we do not see personal transactions. We do not see personal accounts. We don't know what you're doing. We only see aggregated data at the state level in this case, and it's fully anonymized. So as of September 5th, you can see card spending in the various states. We've picked kind of the largest states. Some reopened early, some didn't. And total spending is actually pretty strong across the board. Part of that story is that people are using less cash and spending more on their cards, but part of it also is that a large segment of the population, the ones who didn't lose their jobs, actually have the capacity to spend at reasonably robust rates. Excuse me, oh, after the slide, okay. So I'll keep going. There are some sectors, obviously, that are in deep trouble. You can see that most clearly with entertainment services. However, other sectors like home improvement, we're stuck at home. I actually am just waiting on a delivery of an office chair because I've held out all this time and now my back hurts too much. So I don't want to use my dining chair anymore. So there's this continued drip, drip, drip as we're stuck at home. Demand for home improvement, furniture, obviously. And then obviously online retail is doing great. You can see that in the chart on the bottom left as well. I think the chart on the bottom right is really interesting though. So this is spending broken out by income, again, fully anonymized. And this is spending on Bank of America cards, just to be clear. You can see that there was a big spike in the lowest income group around the 15th of April. That's when they got the stimulus checks. And that group has actually outperformed the rest of the economy throughout. That might seem a little counterintuitive because they're the ones that lost their jobs at the largest rates. But I think there's two things going on here. One is unemployment insurance benefits have, and I think this is great, by the way, but they have been very, very generous. So that has helped lower income people a lot. And the other thing is that lower income people typically have less discretionary spending. So they have less room to cut back. The challenge is, if there's a big cutback in higher income people's spending, then it might affect employment prospects for lower income folks. Okay, so I think there's going to be a poll now.
Okay, about 85% have voted, so let's move on.
Okay. I guess I should wait for you. Okay. Great. Thank you. Okay, so here we have, I talked a lot about, various aspects of the recovery. Let's put everything together and talk about GDP. So here we have the trajectory of quarterly GDP. I just want to point out our Q3 and Q4 numbers have been updated since this presentation was published. We are now at 27% for Q3. That's kind of hinted here anyway. And then and then we're at 3% for Q4. So we went up to 27 for Q3, and then we took 2 points off of Q4 to 3% on the potential risk of another outbreak. This is the point I made earlier. If you look at growth rates, it looks very, very V-shaped. We go from the worst quarter in US history to the best quarter in US history. And then we continue to print numbers 3, 5, 5, 3, 3 that are very good for the US, right? So it looks like a robust recovery. However, if you look at the level of GDP, and these numbers will be slightly higher, but the shape will be the same with our revised forecasts. If you look at the level of GDP, you can see that we're still significantly below pre-virus levels. In fact, in our, according to our forecasts, you get back to pre-virus levels of GDP in the first quarter of 2022. So basically you have lost 2 years, which is not great. And then if you account for trend growth, then you're going to get back there significantly later. Moving on to the next chart. The big reason for the continued weakness in the economy, obviously, is just extraordinary job loss. We have now made up about 50% of the jobs that were lost in March and April, but that still means, the other 50% of jobs still need to be made up, and the pace of the recovery is already slowing down. So once we get past, there's this initial phase where you're going from a closed economy through the reopening phase. And at that time, you're going to get very quick gains, right? In GDP, in jobs, and so on. But once you get past that phase, it's a question of where you are relative to pre-virus. And then it's going to be a hard slog to get back to that pre-virus level. And we worry that we get back to that point pretty soon, which means that we're going to have to slog our way through making up the remaining kind of 50% of jobs that were lost in March and June. Where were the jobs lost? That's shown in the chart on the right. I think this is kind of a neat measure that the St. Louis Fed came up with. It's called a physical proximity index. So to do your job, how much physical proximity do you need to others? And then you compare that to actual job losses. You can see that largely job losses were in services, and services are where a lot of physical proximity is needed to do work. And then, of course, our concern would be that even if restrictions are fully removed, voluntary social distancing will continue to weigh on these sectors. Moving on. Other things we're worried about are kind of the more typical effects of recessions, the second round shocks, if you will. One of them is CapEx retrenchment. So here we have our fund manager survey in which we, our colleagues ask fund managers what they would like to see businesses do with their excess cash. And through most of the recovery, the most popular answer was do more CapEx. Now, the most popular answer by a long way is improve your balance sheets. So in other words, we think that like any typical downturn, businesses are going to use their money to strengthen their balance sheets, which is obviously bad for CapEx. Moving to the chart on the right, jobless claims remain very elevated. So we've had a pretty sizable increase in jobs in the last couple of months. The story here is that there have been just massive flows in and out of employment. So a lot of people getting hired, potentially getting rehired, but at the same time, a lot of people getting laid off. And the worry is that that's actually continuing at a pretty high rate. So still 800,000 people every week filing for unemployment insurance, which is a lot, obviously. It's higher than the peak of the previous downturn. That being said, one qualification is that a lot more people are now eligible because they've expanded eligibility for jobless claims. So let's move on to the next chart. I'll go through the rest a little more quickly so we can leave about 10 minutes for Q&A. Given you a lot of bad news. As I promised in the introduction, there's a little bit of good news here in terms of the policy response. It's just been absolutely massive and very, very impressive. The Fed has almost doubled the size of its balance sheet. The ECB has done something significant as well, not quite as large, but we think they're going to do a lot more next year. And if you look at the other big DM central banks, they have been very, very aggressive as well. They've also all cut rates basically to zero at this point, or they're already negative. Moving to the next page, there's a pretty long list of the policy actions that the Fed has taken. I'm not going to bore you by going through all of them, but the point I want to make is that they've done so much beyond just QE. QE itself was super impressive. There was a point of time when they were doing as much QE per day as they were doing per month during the financial crisis. But beyond that, they have intervened. They've used their emergency powers to intervene in money markets, muni markets, credit, and a few other markets as well. So their thinking, as far as I understand, is basically that the transmission of monetary policy to the economy happens through spread products, right? So you can cut rates, but if spreads blow out, as they did in March, then you're not really the benefit of those rate cuts is not really transmitting to the real economy. So you need to cut rates and control spreads. So after cutting rates, they got down to the business of controlling spreads. The risk, of course, is how do they get out of these actions without shocking the markets? They had better believe, and they'd better be right, that these markets are much healthier now and can, they can digest some unwinding by the Fed. But that's the challenge going forward. Moving on to the next page. Let's talk fiscal stimulus. The CARES Act was massive. It was the largest stimulus bill in history, but aggregate stimulus has still not been as large as during the financial crisis. It has been very helpful for consumers. We saw that in the chart of low-income spending through unemployment insurance. It has been very helpful for businesses. You can see that in the chart on the bottom right. Even as of end June, when the survey ended, 75% of small businesses surveyed said that they have gotten help through the PPP. Just anecdotally, I know someone who's a pediatrician, and she got help through the PPP within a few days. So it was quite effective. But there are still holes that need to be filled. One important one is state and local governments. The big concern here is that we're getting closer to the election, and to help state and local governments, you basically need politicians to give money to politicians from the other party. So regardless of your political affiliations or lack thereof, you can see why that might be a problem. And then in terms of consumers as well, great help from unemployment insurance, but that money ran out as of the 31st of July, or rather the mandate ended on the 31st of July. President Trump's executive order restored half of the $600 per week unemployment insurance checks. That probably makes up for more than half of the stimulus, because people are more likely to spend the first 300 than the next 300, right? So that's good. The problem is that that money will also run out sometime in November, probably. And then it's not clear what will happen next. It'll really depend on where the unemployment rate is by then. Moving on to the next page. Markets obviously have loved all of this. They have priced in a very, very V-shaped recovery. As of a week or two ago, we were at all-time highs in the S&P 500. I believe it was 2 weeks ago. But that does not seem to be consistent with fundamentals. As I said earlier, if you look at the level of GDP, that is probably not going to be V-shaped at all after just 1 quarter of, V-looking kind of growth. So what's the discrepancy, right? And our view is that the main discrepancy here is that markets have a tremendous amount of faith in fiscal and monetary stimulus. And we've done some surveys of investors, and they seem to have the same view, that at the end of the day, when push comes to shove, there will be intervention either from the Fed or from fiscal authorities to make sure that markets are propped up. This is dangerous. Any disconnect with fundamentals is always a point of concern. The fact that the Fed is basically out of ammunition at this point is a point of concern. And the fact that we're getting closer to the election and the odds of basically are not getting a stimulus bill are also kind of concerning, right? So all of this is, making us a little bit worried about markets. The other thing that's worth saying, I think, is that if the markets are basically pricing a policy put, if you will, so policy support if anything goes bad, then as the economy recovers, the chances of something going bad are less, and therefore the markets have to price out their expectations of policy support. So another way in which markets could catch up with the economy is that as the economy gets better, markets basically somewhat flatline, and then the gap closes. So let's see how that plays out. Moving on to the next page. I'll be quick here. What's happened in the rest of DM? There have also been many potential red lines crossed. The ECB has taken some steps that it has not taken in the past. For example, it's now included Greek bonds in its bond buying program, which was previously forbidden because of their credit rating. The EU Recovery Fund, I think this was a pretty big deal because it, the amounts were small. It's not going to make a big difference to the economy, but the fact that they're willing to do joint issuance of debt. So EU countries do not or have not in the past jointly issued debt, right? Germany issues debt, France issues debt, and so on. But now they're issuing, euro debt. Which means that they're pooling their liabilities. That's a big deal. Our big concern was when the next crisis hits, will the euro area fall apart? This shows that unity is an option, even when things are very bad. So that's great. And then even the other developed markets have been very, very aggressive. Moving on to the next page. What are the costs? We talked about this briefly. There's been a lot of concern that inflation is going to blow out because of so much monetary and fiscal easing. We don't think that's right. Once we're past this reopening phase, so once the supply side has kind of healed, there are no more constraints, we're going to be stuck with a more typical downturn where demand is very weak. In that environment, you don't typically get inflation. Yes, there's been huge easing, but that doesn't mean we're overheating the economy. And it is economic overheating that causes inflation. We're not seeing that right now. The more likely outcome is what we call Japanification. So what does that mean? That means that policy rates get stuck at 0 or potentially below 0. Yield curves are very, very flat. Inflation is below target, and central banks basically are out of ammunition. That is our much bigger concern in developed markets. In emerging markets, moving on to the next page, the concerns are a little bit different. It's quite amazing how many emerging market central banks have been very aggressive. A lot of them are actually doing QE. This is a slightly dated chart. It would have even more colors on it if I had updated it. A lot of EM central banks, as I said, liquidity support, QE. The worry for EMs is that they don't typically get as much benefit of the doubt from markets. if they have a blowout in inflation, if the markets think that the central banks are monetizing the debt, basically just financing borrowing by the government, then they're more likely to punish these countries. And you could get runs on emerging market currencies. So that's a concern. Moving on to the next page. Risks. So the big upside risk, as I mentioned at the start, is a vaccine. Our base case is we get it in the third quarter. And by that, I mean that we have something that's kind of widely available to developed markets in the third quarter. Upside, let's say we get it in the first quarter of next year. The broad principle is that the winners will be countries that are in developed markets because they'll get them first, they'll get the vaccine first, and countries that are that don't have the virus under control. So under both of those principles, the US will do best and emerging Asia will do the worst. But overall, we think that vaccine would be more of a performance enhancer, if you will, than a game changer, in the sense that it won't end social distancing all at once. It won't, sort of get rid of all of the problems around recessions all at once. Moving on to the next page, downside risks. The big one is kind of deterioration in US-China relations. The phase one trade deal is virtually dead. You can see that in the chart on the right. There's no way China is going to meet its import targets in the deal. Going into the election, we don't expect kind of economic disruptions like tariffs. We expect politically significant actions like we saw with the consulate closures. After the elections, things get a lot more interesting. We think there'll be some decoupling in tech and medical supply chains. That's already started with the US's actions against Huawei. But the question is, will things look very different under a Biden presidency than a Trump presidency? To a degree, yes. We think President Trump will be more hawkish on China in the short run. In the longer run, though, it's possible that a Biden administration would be able to build stronger relations with the US's traditional allies. And so that could actually be worse for US-China relations. Either way, this is another headwind next year. Moving on to the last slide. Politics are another problem. I talked about the risks around not getting another stimulus bill, risks to state and local, risks to consumers as well. And then the election itself is a concern. The key battles we think are not around taxes and regulation this time. They're around the coronavirus, China, and so on. If you just look at the polls, Biden is ahead in the presidential election. Democrats look favored to keep the House, and the Senate looks like it's a close call, but the numbers favor the Republicans. Either way, if there's gridlock, you have one party controlling the House, the other controlling the Senate. Regardless of who's president, not a lot gets done. The last thing is, yes, there's a risk of a Democratic sweep. I would say that's probably the highest probability tail outcome, if you will. That regime change can be turbulent for markets, but we actually think a Democratic sweep would be positive for growth. So I'll stop there. We have a couple minutes for questions.
Okay, we have one question. If a $3 to $4 trillion tax increase happens next year, what's your best projections on the impact to the economy?
If a $3 to $4 trillion tax increase happens next year?
That's what the question.
Okay, sure. So that would not be good for the US economy. I also think it would be unlikely. A tax increase, let me go through some nuances here. So first of all, it'll depend on which taxes are increased, how the revenue is spent. But overall, I mean, it's just unlikely that we'll get a big tax increase when we're in the middle of a recovery. It just seems very, very unlikely. But if it does happen, it's probably not going to be great for growth. There was another question: why is a Democratic sweep good for growth? So first of all, I think joint government will help because it'll actually help get things done. This is not a partisan statement. I'm not trying to, take sides or anything. But if we have gridlock, as I said, nothing's going to get done. The other our concern is that the handling of the virus has not been great at the federal level. We've written this. This is just not just my personal opinion. And we think if the virus were handled a little bit better with more coordination, more focus on testing, contact tracing, and so on, we might be able to get past it sooner, which would also be good for the economy. And then there was another one that said, are Republicans anti-growth? No, I don't think anyone is anti-growth.
There's a question asking at what point the debt becomes a problem.
That's a question we get all the time.
And
It is really amazing. I mean, I'm really amazed how persistently low yields remain. It's a bit of a mystery how across developed markets, countries are basically able to get away with huge levels of debt. But it is also an empirical fact that is hard to sort of argue with at this point. So yields have remained very low, and that is a reason to potentially take on more kind of growth enhancing spending, even if that causes the debt to increase. And I think both parties have actually come around to this view.
okay, we are at our 50-minute point. So, and there's no more questions. So I thank you again. It was an awesome presentation. A lot of positive mixed with a very bad situation we're in. But, I enjoyed it for one. So I thank you. All right, session's over. We had 207 people.